Beginner's Guide to Investing. Turn small money into big wealth. Investing can often feel intimidating, especially for beginners. The world of finance is filled with complex jargon, fluctuating markets, and countless investment options that seem overwhelming at first glance. Yet, building wealth doesn't require a huge sum of money or insider knowledge. Even small amounts, if invested wisely and consistently, can grow into substantial wealth over time. The key lies in understanding the basics, starting early, and developing a disciplined approach to investing. Understanding the basics of investing. At its core, investing is about putting your money to work to generate more money. Unlike simply saving in a bank account, where your money earns minimal interest, investing aims to achieve higher returns by purchasing assets such as stocks, bonds, mutual funds, real estate, or other financial instruments. While investing does involve risk, it also offers the potential for growth that saving alone cannot provide. One of the most important concepts for beginners is the power of compounding. Compounding occurs when the returns you earn on your investments are reinvested, allowing your money to grow exponentially over time. For example, investing a modest $100 per month into a diversified portfolio with an average annual return of 8% could grow to over $200,000 in 30 years. This demonstrates that even small, consistent contributions can yield remarkable results if started early. Setting clear financial goals. Before you even begin choosing investment options, it's essential to define your financial goals. Are you investing to save for retirement, purchase a home, fund education, or simply build long-term wealth? Your goals will determine your investment strategy, the level of risk you can tolerate, and the time horizon for your investments. Beginners are often advised to start with long-term goals in mind and focus on steady growth rather than attempting to chase quick gains. Clear goals provide direction, helping you make informed decisions and avoid impulsive moves during market fluctuations. Choosing the right investment accounts. Selecting the right type of account is a crucial step for beginners. Retirement accounts, such as a 401k or an individual retirement account, offer tax advantages that help your money grow over decades. Some employers even provide matching contributions to a 401k, effectively giving you free money to invest. Brokerage accounts, on the other hand, are flexible and allow you to invest in stocks, bonds, mutual funds, and exchange-traded funds, ETF. While these accounts do not have contribution limits like retirement accounts, they are subject to taxes on gains. For those with limited initial capital, micro-investing platforms can be a great starting point. These apps allow you to invest very small amounts, often as little as a few dollars, making it accessible for anyone to start building an investment habit. The importance of diversification. Diversification is one of the most critical principles in investing. By spreading your investments across different assets, you reduce the risk of losing money due to a single investment's poor performance. Beginners should consider a mix of stocks, bonds, ETFs, mutual funds, and even real estate. Stocks represent ownership in companies and provide high growth potential, but come with higher volatility. Bonds are essentially loans to governments or corporations that pay interest over time and are generally less risky than stocks. ETFs and mutual funds are collections of stocks or bonds that provide instant diversification even with a small investment. Real estate, whether through direct property ownership or real estate investment trusts, can generate passive income and serve as a hedge against market volatility. The goal is to create a balanced portfolio that aligns with your risk tolerance and long-term objectives. Start small, but start early. Many beginners make the mistake of waiting until they have a large sum of money before investing. However, the reality is that time in the market is far more important than timing the market. Starting with even a small amount, such as $50 or $100 per month, allows you to take advantage of compounding and build wealth gradually. Consistency is key, and regular investing helps smooth out the ups and downs of the market. One effective method for beginners is dollar cost averaging, which involves investing a fixed amount at regular intervals. This strategy ensures that you buy more shares when prices are low and fewer when prices are high, reducing the impact of market volatility over time. Continuous learning and education. Investing is not a one-time task. It is a continuous learning process. Beginners should dedicate time to understanding how the stock market operates, the fundamentals of bonds and other fixed income investments, and the principles of risk management and portfolio allocation. It is also essential to understand the tax implications of different investments. Books, online courses, financial podcasts, and reputable blogs are valuable resources to build financial literacy. The more knowledgeable you become, the more confident you will be in making informed investment decisions. Education reduces fear, helps avoid mistakes, and allows you to recognize opportunities that others may overlook. Avoiding common beginner mistakes. New investors often fall into predictable traps. Chasing the latest market trends or investing in a hot stock without proper research can be disastrous. High fees, whether from brokerage accounts or mutual funds, can also significantly erode your returns over time. Borrowing money to invest, known as leveraging, might amplify profits but can equally amplify losses, especially for beginners. Perhaps the most damaging mistake is emotional investing, making decisions based on fear or greed. Markets naturally fluctuate, and reacting impulsively to short-term movements can lead to poor outcomes. By staying disciplined, following a plan, and keeping a long-term perspective, you reduce the likelihood of these mistakes and improve your chances of growing wealth. Monitoring and adjusting your portfolio. Once you begin investing, it is important to review your portfolio periodically. Life circumstances, financial goals, and market conditions change, so your investment mix may need adjustment over time. Rebalancing ensures that your portfolio remains aligned with your risk tolerance and long-term objectives. However, avoid over-monitoring or reacting to every market swing. Investing is a marathon, not a sprint, and patience is one of your most valuable assets. The mindset for wealth building. Successful investing is as much about mindset as it is about strategy. Cultivating a long-term perspective, embracing consistency, and practicing patience are essential. Building wealth does not happen overnight. It is the result of disciplined investing, learning from mistakes, and staying committed to your financial goals. Remember that even small investments, when combined with time and knowledge, can grow into significant wealth. The journey of investing is not just about money. It is about creating financial security, freedom, and opportunities for the future. Thanks for watching. If you're ready to start turning even small amounts of money into big wealth, remember, it's all about consistency, patience, and smart choices. Start today, stay disciplined, and let your money work for you. Don't forget to like this video, subscribe to the channel, and hit the notification bell so you never miss tips on building your financial future. Comment below with your first investment goal. We'd love to hear what you're aiming for. See you in the next video.